Hello, everyone. Today we're going to talk about Microsoft, a company you all know very well for its Microsoft Office suite and the Windows operating system. Once, that was the company's main business, but times change, and today the core business is Microsoft Azure. This is a cloud computing system, and essentially it's data centers scattered all over the world. And many businesses, even entire corporations, rent computing power from Microsoft for a wide variety of purposes. And you probably didn't know that ChatGPT operated exclusively on Microsoft Azure for a long time, and only very recently started using other services as well. Now, let's take a look at the stock chart. These are monthly candles. Here, they start from the year 2000, although in reality, the stock has been traded on the stock market since 1986. And it should be noted that it has gone through a huge number of splits, that is, stock splits. And if you had bought one share in 1986, thanks to the splits, today it would have turned into 288 shares. At the time of the IPO, or initial public offering, the stock cost $21. Today, those 288 shares would be worth more than $130,000. That's how easily in 40 years, $21 turns into $130,000. But there's a nuance. Today, we're all smart. But back then, so long ago, recognizing that this was the company to invest in was, of course, not easy. Now, let's look at another point. The yellow segment connecting 2 points. The first point is the peak of the year 2000, when the dot-com crisis began and the stock started to fall, reaching its lowest point during the mortgage crisis in 2009. Then it returned to the point from which it started to fall, around $60, and this happened in 2016, that is 16 years later. Why am I showing you this? I'm showing you this so that you understand that investing at the wrong time can make your investment unprofitable for as long as 16 years. And if we look at the Nikkei index, we see a similar situation. Only there it lasted not 16 years, but 30 years. That is, the index fell and took 30 years to recover to its previous values. Is it worth buying now? I'm not sure. If we look at the red segments, that's a divergence that ended with a correction that wasn't very deep. The stock fell from about $350 to around $200, so it wasn't even by half. And according to the RSI, we haven't reached the zone that we saw during the mortgage crisis, namely the area around 30. That is, this is already the oversold sound. The 50-month moving average kept the stock from falling. Then growth resumed, and a new divergence formed, marked by the yellow segments. And now, attention, here's a question. This drop, which was about 20% from the peak, does it really match the scale of the previous growth? Most likely it doesn't. Should you short this stock? I'm not sure, but it's definitely not the best time to buy right now. First, the presence of a divergence indicates the risk of a decline. Second, if you are going to buy, it should be after a deeper drop, at least down to the area of the 50-month moving average. And considering that we've already dropped down to this average twice, the next decline could go even lower, to around $270. Also, if you remember one of our previous reviews, we noticed that the price tends to return to the point where the divergence began. So, following this logic, the stock could fall to around $100. Yes, it may seem unreal, but remember the Great Depression. Back then, the market dropped by about 90%. Everything was gone. If you look at the monthly candles up close, you'll see that a bearish engulfing of the July 2025 candle has occurred here. This engulfing happened in November 2025, and the target for the decline was the base of the June candle, $457, which we have successfully reached. But now, since we don't have any reversal patterns, the next downside target is $431. The next target is to close this gap here at $392. And finally, the next target is the base of the April candle, which is $375. And right here, we also have the 50-month moving average. So before $375, I wouldn't consider any purchases. I would also be patient and wait for the point when the RSI indicator enters the 30 value area. Yes, it might take many years to wait, but that's much better than sitting for years in a losing position that you bought at a very high price. Now, let's switch to the weekly candles. On the weekly candles, we can see that a very important level is being tested, the local high from July 24th at $467.39, as well as the 50-week and 100-week moving averages at the same time. If we take a closer look, we can see the following. The $467 level was broken downward last week, and although this week closed with a green candle, it still closed below the $467 level. This means that, formally, the downtrend remains in place. If we see that the green candle of the current week, or any other week, consolidates above the 50-week moving average and above the $467 level, then we can expect growth. But is it worth buying? Answer that question for yourself. On the daily candles, the picture's even more interesting. Notice that the stock opens with a huge gap up, meaning it sets a new all-time high and immediately starts to fall. Another attempt to reach a new all-time high with a gap up, and again it starts to decline. This means that there is a group, likely very powerful investors, who are using price spikes to exit their positions and turn their stocks into cash. This means that somewhere in this area, there's a very strong seller who is able to push such a powerful company downward. But what are we seeing right now? We see that all the moving averages have been broken downward, including the 300-day moving average, which is shown in blue. And now we've got a bullish engulfing pattern on the daily candles. What can we assume? We can assume a test of the 200 period, 50 period moving averages, and even the 100-day one, which is shown in red. So based on the current situation, I would expect a move somewhere into this area, followed by a decline. Of course, the situation could develop higher, maybe even to a new all-time high, but it's very likely that it will go down. And as for where it might go down, we've just outlined that. So this isn't the main target, but let's say the nearest basic target for a decline is $375. I want to emphasize it's not forbidden for the price to update the all-time high one more time. But note that every time the high is updated, it ends with selling. And the first round of selling found a low around $505, while the second round was initially around $475, but then the price dropped as low as $440. With that, I suggest we wrap up today's review. Whether to buy shares or not is up to you. I've shared my point of view with you, and the next review will be about Bitcoin. If you don't want to miss it, subscribe to the channel, hit the bell, and leave your comments about which instruments you'd like me to analyze. All the best. See you next time.